As the Dow hits unprecedented heights and the S&P 500 nears its own peak tantalizingly close to it, there's a battle below the surface that could determine which way stocks go from here. Jackie DeAngelis explains.
The bulls are at it again. Another day, another all-time high for the Dow. But despite the impressive run, there's an underlying tug-of-war being played out in the U.S. economy.
We had a couple of huge risks hanging over the global economy for the last year. Would China have a hard landing? Would the euro break up? Would America fall over its fiscal cliff? None of those things happened.
But several good things have happened, including more signs today of a turnaround in the labor market. The number of people claiming initial jobless claims falling last week to a lower than expected 332,000. That following last Friday's February employment report, which showed the unemployment rate fell to its lowest level since 2008. But while the outlook on jobs is improving, inflation is putting more pressure on U.S. businesses. Producer prices, or the cost of businesses to manufacture goods, rose again in February, climbing nearly 1.7% in just the past year, pushed higher by rising gas prices. At the same time, the U.S. dollar has shown some relative strength, up 4% in just the past 2 months against the other major currencies. And while a stronger dollar sounds great, it can actually hurt American business, making U.S. exports more expensive to foreign buyers.
To the extent that you continue to see the dollar appreciate, it means that you want to be a little more cautious about buying multinational companies whose profits get weakened when the dollar goes up.
So far, the tug-of-war playing out in the economy hasn't been enough to derail this rally. But experts on Wall Street caution that even the strongest markets face headwinds.
It would be completely irresponsible not to expect some sort of volatility, within the first half of this year. But there's a soft floor for equities, and any discount like that presents a buying opportunity.
For Nightly Business Report, I'm Jackie DeAngelis.
Let's delve a little bit deeper into the rally and get a pulse of the individual investor along the way. Brian Belski, Chief Investment Strategist at BMO Capital Markets, and John Sweeney heads up Retirement Services for Fidelity. Welcome to both of you. Mr. Sweeney, let me begin with you. I know that you have a survey that you're going to give us a sneak peek look at tonight. It doesn't really come out until tomorrow, in which you look at what you call high net worth investors, people with more than $250,000 in investable assets. And the results of that survey indicate that those individuals are getting more bullish, and specifically more bullish on U.S. stocks. Tell me.
That's right, Tyler. So we were pleased to see that a message that we've been trying to get into the market for about 14 months now is really resonating with investors. You've seen this in the flows into equity mutual funds over this period of time. Certainly the recent euphoria in the market has been something that has attracted a lot of media attention. What we like to try and remind investors is not 10 days, but really 10 years you want to be focusing on when you think about equities.
Brian, let me ask you about the strength of this rally. Is this just a market rally, or is it something bigger? Is this the beginning of a bull market cycle?
Well, when you take a look at major bull markets, typically they start when doubt is very high, and what I like to call this the bunker bull market. Most investors are still in the bunker and not believing it. And so from a longer term perspective, we think we're on the cusp of the next great equity bull market that could be 15 years in length. That doesn't mean we can't have some periods of excess volatility and even down years. Case in point, if you take a look at the 1982 to 2000 bull market, 1987 was a volatile year, if you remember. 1994 was a volatile and flat year. So we could have some periods like that. But the bottom line is we believe that individual investors are very underweight equities, and institutional investors around the world are extremely underweight U.S. stocks. And we think from a fundamental perspective, U.S. companies are the best and most attractive asset in the world.
Well, that certainly seems to be, Brian, what the folks who responded to John Sweeney's survey are indicating, because they indicated that 2/3 of them were going to put money into U.S. stocks. Mr. Sweeney, let me ask you, do you see what Brian sees in your complex there at Fidelity, namely that people are still underweight U.S. stocks compared with what they ought to be? And is that behavior changing? Is the flow of funds more into equities so far this year or not?
It is, Tyler. We're seeing more flows into equities this year, which is a good trend. Obviously, we've seen about $1.3 trillion cycle into bond funds over the last 4 years, and that's really rocking the boat to one gunnel. And really what we need to do is get people back to the middle. When you think about a diversified portfolio on a long secular trend, we're going to see people continue to buy fixed income as the population in America ages. But I think that we need to keep inflation in mind when we think about allocations to equities. Equities are the only place that is really going to outpace inflation over long periods of time. And people investing in whether it's for accumulation or even income distribution need to be thinking about inflation when they think about their allocation to equities.
Brian, I want to ask you about, we're all waiting for the S&P to hit its closing high, just a few points away. For investors, and I guess for market strategists, which is more important for you to see the strength of this rally? Is it these new highs on 30 Dow components, or is it the S&P 500?
It's really the S&P 500. For instance, we do not forecast 30 stocks. We forecast a target both in terms of price and earnings, Susie, for the S&P 500. I'll remind investors that our target last year was 1425 and the market closed at 1426. This year's target is 1575. Clearly, we're within reach of that. And it has an upward bend, especially given the fundamental construct of the U.S. market we think can improve over the second half of the year. But the 500 stocks of the S&P clearly are a much more diversified way to look at the U.S. market. And frankly, U.S. investors, U.S. portfolio managers benchmark themselves against the S&P 500, not the Dow. So that's really the clear component that most investors should really focus on, and it would be a really key element with respect to the longer-term strength of the U.S. market.
You said that bull markets go up and down and along the way. I mean, what could jolt this market?
Well, we think from a macro perspective, it's employment. Employment's the great circle of life. That's why housing's come back. That's why the stock market's come back. That's why the economy's come back. If we see some sort of bump in the road with respect to employment, I think that could really surprise people. Now, from an historical perspective, the job gains that we're seeing relative to history are very slow. That's why we like to talk about the construct of the U.S. market in a bit of a nursery rhyme type of situation where it's the little engine that could. We continue to kind of climb higher and trudge higher. Slow job growth, slow GDP growth, slow earnings growth, and low interest rates is a great time to be invested in equities. Now, bear in mind, investing is not a binary event. You have to be diversified. You have to own some fixed income. You have to own some commodities. You have to own some real estate, and you have to own some equities. It's not an either-or type of event, but overall, from a longer-term perspective, we still believe that people are underexposed equities because of the ills of the last 20 years.
John, I really want to ask Brian. He said 1425 close on the S&P. It closed at 1426. I don't know how he got it so wrong there, but at any rate, I ask you this: when baby boomers start to retire and pull money out of their accounts to pay for expenses, what do you think is going to happen to equities?
You know, Tyler, the important thing is, as Brian mentioned, is you want to keep exposure to equities. Within your diversified portfolio, equities are going to be the place that outpaces inflation. So what we ask folks to think about is when they're planning for a 30-year time frame in retirement, really have a significant allocation to equities. For a 65-year-old, that means almost 50% of their portfolio. Clearly, over the last 5 years, that's been a difficult market to weather through, as the equities have had a significant pullback over the last 5 years. But really, when they keep a perspective of how long they're going to need their money to last, a 30-year time frame, equities provide a really good growth prospect for them over time.
So I take it then, if investors do what you think they ought to do, there would be relatively little effect on equity values.
You know, I think over long periods of time, you're going to continue to have people pull money out, as you suggested, but the economy is going to continue to grow, whether it's population growth, manufacturing growth. The U.S. economy is well poised to capitalize on that from our perspective.
Gentlemen, thank you very much. Brian Belski, John Sweeney, appreciate you being with us.